Happy Navami to everybody. It's Saraswati Puja, the day we worship knowledge. So an important day for all of us here in India. Well, actually, the markets also seem to be returning to the pink of health. The last 24 hours have seen a return of risk appetite. US bond yields fell sharply overnight by 16 basis points to 3.64. And actually, if you compare from last week's 4%, it's an even sharper fall. Dollar index likewise is down to about 111.5 from 112.5 yesterday and 114.5 last week. But the real problem appears to be the corporate bond market, the credit markets in the US, which have frozen very badly. The Bloomberg US Aggregate Bond Index has fallen by 16% in the last 2 years, and this is apparently the largest fall in over 25 years. The financial health of banks like Credit Suisse has been another source of worry for these credit markets. To discuss more about whether the US corporate bond market can destabilize global markets, I have with me Steve Englander, the global head of G10 FX Research and North America Macro Strategy at Standard Chartered Bank. And in a bit, we're going to be joined by Khoon Goh, head of Asia Research at ANZ. Gentlemen, thank you very much for joining me. Steve, thank you very much, first of all, for staying up for us all the way from the US. Let me, first come to you about the health of the corporate bond market. Corporate bonds in the US have been falling sharply. Do you think this market can destabilize other global markets like EMs, currencies, equities?
I think it's a sign that global markets are worried about something, whether it's liquidity or whether it's that the central banks are overdoing it, or whether the dollar is too strong and it's dollar strength that's putting too much pressure on balance sheets. It's not yet at a critical moment, but it's something that has caught everyone's eye. That, till now, credit markets have been very, very well behaved, and the widening of spreads, I think, is being viewed as a very negative sign at this, at this stage of the business cycle and the tightening cycle.
I'm not asking you to comment about a rival bank like Credit Suisse, but do you think the market is vulnerable to defaults by any large finance company? I mean, after all, this time banks say they are better capitalized, they have cleaner balance sheets than it was during the Lehman crisis. So can there be a destabilizing finance company problem?
I think it's much less likely than was the case in the great financial crisis. As you say, there's banks are much better capitalized. Their balance sheets are much more transparent and much cleaner. There's always this fear element that could emerge. And sometimes it happens because of a clear, headline. Sometimes it happens just because markets panic. We don't see it yet, but what's clear is that this nervousness is there.
Okay. Many institutions are taking counter steps. We saw the BOJ intervene when the yen fell. The BOE did in the credit market. The UK government has cancelled its tax cut. And today, the United Nations trade body, UNCTAD, has requested central banks to slow the rate hikes. Are we at least at the end of a tumultuous time?
I think it's premature to say that we're at the end of a tumultuous time. I think that central banks, and I'm thinking about the Fed here, but I think it's true of other central banks as well, that they want to get the job done on inflation. And there have been so many times in the past where ripples in financial markets have deterred tightening, and that ended up, being head fakes that the central banks kind of backed off when they shouldn't have. So I think that central banks are going to be very careful if it does turn out that there's a financial market crisis. Of course, they're going to slow their pace of hiking, but I think they're going to look very carefully to, before taking that move to make sure that it's necessary. And I think the comments from the central bankers, again, thinking of the Fed, emphasizing the battle of against inflation while acknowledging, that there could be issues, but it's clear their emphasis remains fighting inflation.
No, let me scratch that point further. Exactly what you said. Are you penciling in a slowdown of the rate hikes by the Fed, or is the market penciling in anything like that?
I think they are to some degree. Today's price action was precipitated by softish ISM manufacturing numbers that came in. So I think there may be an element that the market is thinking that the slowdown is nearer than they thought a month ago. But I think that so far you're not actually seeing much change in the view of kind of where the peak is. It's moved a little bit. It hasn't moved a lot in terms of where peak Fed funds is going to be. But I think that the markets may be more comfortable that inflation is going to come off quicker, and that the amount of time that we spend at the peak won't necessarily be as long as was thought earlier.
Okay, well, Steve, just hold on for a bit. Let me invite Khoon Goh of ANZ Research also into this conversation. Khoon, thank you very much indeed for your patience. I wanted to ask you the same thing. You know, this terrible news we get from credit markets day after day in the US, is it having any ripple effect in Asia at all?
Well, at this stage, it's not really having any specific impacts on the credit markets. I mean, in Asia, the focus has mainly been on the Chinese property developers, and that's really specific to that country and to that sector. We haven't really seen much of a ripple effects into the other credit markets in this region at this stage. I think most of the concern has been around the pace and aggressiveness of Fed tightening and the strong dollar, which has been putting a lot of pressure on regional currencies here. And of course, the looming slowdown in the global economy, which will impact on exports in this region.
Yes, the strong dollar is an issue. Actually, Khoon, let me get Steve as well on that. Steve, what do you make of the rupee? We've seen it come back, pull back from that 82 per dollar mark. Do you see it crossing 82 again? I mean, do you fear 83?
We do, yeah. We think it can go up to 83. I mean, there's still balance of payments issues. There's still inflationary issues, and the RBI kind of has been using its reserves to defend the currency. So there's kind of not a question mark, but they've used a substantial amount of reserves already. So we think it could go a bit higher at this stage, and it could be that pushes up bond yields as well.
So much will also depend on the dollar index. Now, that has come off from 114 last week. Do you see it going back to 114.15, or is the worst over there?
Let me put it this way. I think we're close to the worst being over. I don't necessarily think the worst is over. A lot of this is very data dependent. Right now, I think everyone in the market and people at the Fed are praying that the numbers get softer, so that the need to sort of keep sending the message of ongoing aggressive hikes, that need diminishes. But there are too many risks in the world, whether it's Ukraine war, the energy situation, Chinese growth. I think it would be premature to say we've hit a peak, even though we're reasonably comfortable with the idea that maybe we're not far off that peak.
Okay. Yeah, you're right. I mean, who knows about geopolitics? Khoon, what's your view? After all, the dot plot has clearly told us that the Fed is going all the way up to 4.62. And that's mostly priced in, you think, or there can be still further attacks on EM currencies?
Look, I think there's going to be further pressure on emerging market currencies, to be honest. I think the Fed is signaled very clearly they intend to bring inflation down, and even if they drive the US economy into recession, that's a price they're willing to pay. And they're not too fazed by dollar strength at the moment. I mean, most other countries are worried about dollar strength, but not the Fed, because a strong dollar does help them in their inflation fight. So given that, our view is the Fed might take the Fed funds rate all the way to 5% by middle of next year. That's slightly more hawkish than what the market is pricing in. If our view is right, there's going to see further strengthening in the dollar. I think the DXY, for that reason, can continue to retest that 115 level, and that's going to put further pressure on emerging market currencies, including in Asia. And dollar yen, I believe, is one pair that will continue to see upside. We're forecasting a move towards 150 on dollar yen simply because the BOJ remains at the opposite spectrum in terms of central bank policy making.
Oh my God, 150. Okay, we are not that linked to yen in India, but certainly linked to the yuan. We have a lot of trade deficit with China. China's at the moment closed, and for the last few days, we are, the Chinese currency is showing 7.11, 7.12. Do you see more depreciation of the Chinese currency and therefore the rupee? Where do you see the rupee?
Well, for the Chinese yuan, I'm expecting it to weaken towards the 720 level. I know the Chinese authorities have recently come out with very strong language warning against further depreciation. But let's face it, with China still pursuing a COVID-0 strategy, their growth has really slowed markedly, and the PBOC has recently eased policy, and we expect them to continue to ease policy to support growth. So the widening yield differential will continue to put pressure on the Chinese yuan. In terms of the Indian rupee, it's already weakened quite substantially already, and I think the RBI has been very aggressive in trying to prevent further depreciation by intervening in the FX market. We think they'll continue to try and hold the 82 level. Part of the reason for not wanting the rupee to weaken too much is because of inflationary concerns. Although the RBI has already spent quite a lot in terms of their FX reserves, we estimate that they could easily go through another $30 to $40 billion before reserve adequacy becomes an issue. So we expect the 82 level to hold in the near term. And that's largely predicated on the fact that the Indian economy continues to do very well. It's starting to attract inflows, both FDI and portfolio flows, and that will help to stabilize the rupee.
Oh, that's an optimistic note to end this conversation. Khoon Goh, pleasure having you with us. Steve Englander, thank you very much for staying up for us. Steve does expect that there can be more, attacks from the dollar and its strength. But Khoon Goh confident that India perhaps could be an outperformer, with 82 being resolutely protected by the RBI. Steve is looking for 83, not Khoon Goh just yet. We'll wrap up on Bazaar on that note and turn over to trading ideas on Chartbusters.